We're going to talk about rebalancing your portfolio when you're retired. Rebalancing a portfolio means changing the mix of your holdings, stocks, bonds, cash, whatever you might have. Eventually, things might get out of whack and you want to rebalance it. But the question is, do retirees have any different challenges? And the answer is yes. But speaking of balancing, let me bring in my co-host Tony Shorlett to balance out the program with my knowledge and your bliss.
Nothing but noise over here, Dan. We love to get comments on the videos. I love to see them. Well, Dan has all the information. What does Tony bring to the show?
The good looks and charm. Tony,
Yeah.
we're going to talk about rebalancing today.
Eye candy.
But I'm going to bring in an expert here. I'm going to share my screen and we're going to watch a video that I think really captures the essence of rebalancing. Are you ready for this?
I am so ready. It hurts.
Every time I share my screen, it's a risk, but we're going to try this one out and then talk about it.
And no scare fish.
So when am I gonna learn how to punch?
Better learn balance. Balance is key. Balance good, karate good, everything good. Balance bad, better pack up, go home. Understand?
Yeah, I understand.
But you didn't show the fun part where he shakes the boat and makes him fall into the water. Where Miyagi
who knows? I might
the
bring
boat.
that later in the podcast here. So that was a clip from The Karate Kid.
Oh yeah,
and the all-time best teacher of Mr. Miyagi says, "If your balance isn't good, nothing's good." Is that true though for retirees? I'm going to challenge Miyagi on that one. So let's talk about why people would rebalance first. And this might be common sense to people, but the balance of a portfolio can change over time, and you rebalance it because you want to keep your risk the same. You don't want the market to determine your risk. For instance, let's say, Tony, you say, I need 50% in stocks and 50% in bonds. This is typical, stock bonds.
right.
Then, so you do that, and then the stock market rages like it has in the past couple of years. And all of a sudden, you're at 60-40 because the stocks have gone up in value and the bonds have kind of stayed or gone up a little. And now you're out of your original balance. So do you change that or not? So the reason you would is because you don't like the extra risk. So you're like, I want to tone it down.
Mm-hmm.
Now, from my clients and my practice, it's not just about stocks to bonds. There's other things that we invest in. We have real estate. We have annuities or fixed annuities that give like a cash equivalent. We got CDs, cash. We have gold or precious metals. So we might have a structured note from a bank. So there's different assets.
Cash value life insurance, right?
Right. Someone might have life insurance, cash, whatever. And so it's not just the stock bond mix that people use, but that's the easy one to understand how things can get out of whack.
It's basically, we're talking about where your money is at, whether it's sitting
Right.
in the bank or how much you have there, how much you have in a stock or a bond.
So a lot of people will rebalance to get their risk in line with what they wanted to begin with. And as the market changes, their option, what they own can get out of line for what they originally wanted. Or their risk might change and they want to rebalance to be more in line with how they feel today as opposed to 2 years ago. Another reason people rebalance is for tax purposes. And this is a strategic way, especially for non-IRA money. They'll say, well, I have a loss here on this investment of $500, but I have a gain over here of $500. So let's sell both. And they wash each other out and I don't pay taxes on it. And then I can reset and rebalance. So that's called tax loss harvesting, or there are other tax reasons people rebalance. And then the last would be an opportunity. So Tony and I, we might have our investments as they are right now, but then Tony says, hey, turns out the local pizza buffet is up for sale. I'd like to invest. You want to put 50K in? Let's buy this thing. And so we would rebalance our risk portfolio. We might have to sell stocks or bonds or something to then buy into this business as an opportunity. So people will rebalance for that. But the question becomes, what about retirees? Because this is a show about retirement, Tony. Retirees have different set of challenges. Now, you throw a retiree on the boat, like, with Karate Kid up there, it's going to be a different story. I was impressed at how quickly he got on that boat. I was looking at that when I watched it. I have a feeling that boat was anchored and it was a prop. I don't know if they were really in the water. Maybe they were, but he handled that pretty well.
Yeah.
But retirees face a different set of risks when it comes to rebalancing, because first, they're not contributing anymore. A lot of times what you could do is, let's say, Tony, you right now, you're at a 70-30 portfolio, as an example, 70% stocks, 30% bonds. And the stock market's done really well this year. And now you're at 75-25. And you don't like that. And you want to rebalance. What you could do is say, my 401k contributions are going to go all toward bonds as opposed to stocks, so that over the next year, my bond portion will come back in line with the stock portion. So you're not necessarily selling the stocks to buy bonds. You're just, new money going in is going into the bucket or category.
So when you're dollar cost averaging your way back in,
Yes.
because you're regularly contributing, that's a huge advantage over those in retirement who are no longer have that bi-weekly or monthly check going into the account every week.
Right.
To
So
help with, yeah.
Right. And if you weren't contributing anymore and you're retired, say, now you have to sell something and buy something as opposed to just adding more to balance.
Right.
So that's something that they face, retirees face. Also, retirees risk changes quickly. Everyone thinks it changes over time as you get closer to older. That's not how it really happens in life. A lot of it is a switch. It's I retired, and now they're like, wait a second, I'm not adding anymore. My accounts are going down. All of a sudden, I become much more risk averse because I don't like this. I'm scared, right?
Right.
So it's drastic. Whereas for most people, when they're working, they're not really thinking about their risk profile changing
Because they know they'll always have more income coming
they can
in.
keep working or something like that.
Yeah.
It's not a good strategy to just do a rapid change when you retire. You should be thinking about it ahead of time. But for most people, the case is it's a rapid change. It's a dramatic change. And then finally, and probably most importantly, and what I want to get to in this conversation is retirees are pulling income from their retirement, their savings, and that changes the rebalancing techniques that are allowed, because not only are they not contributing, now they're pulling from their retirement accounts, and that could change what's happening to their balance depending on where they're pulling from, which part of the portfolio they're pulling from. So let's talk a little bit more about that. Income wise, my philosophy is you start with the income. Let's figure out what your income need is, and then balance your portfolio after that.
And that's the trick. That's why you're in business, and that's why you have your job, is to solve for income. That's what I call it. Is that's your main job with people, because people don't understand how to do that effectively without, to know they're not going to make costly mistakes, which are going to derail their retirement, or they're going to end up at some point with not enough money to cover the bills or expenses. You have to solve for income. No matter how much money you have or how little you have to solve for income in retirement when you no longer have a job.
Right.
Yeah.
And let's assume now you've solved for that income. Okay.
Right.
So we've created a plan.
Yeah.
And you've got the income you need. Do you then need to rebalance? That's the question. And I might argue that you don't. Let's take an example of my dad. He's still alive. He was a public school teacher, and he has a public school teacher pension. He also has Social Security. That's his only sources of income. He's got a small IRA that he takes the required minimum distribution from, but it doesn't really move the needle much. My dad's IRA is invested. Does it need to be rebalanced often or not? Well, if you ask him, he's like, I don't know, right?
Right. That's
But
most
if you ask
people.
me, right, they don't want to, I don't know. Does it need to be rebalanced? For him, his income is more than he spends. So every month he's adding to his savings. And just spending his money is the challenge, which is a good problem to have.
Yeah.
So does it really matter how balanced his portfolio is? It's not as high stakes as someone that is using that income, using that portfolio to generate income, or is still looking to retire or new to retirement, and they're worried, I hope this will last because I'm going to need income from that. My dad's sources of income are guaranteed, and it's set, so the rebalancing isn't as important for him. So it's different. So that's why I often say I like to start with income to try and get that baseline income need set so that the rebalancing, the investing, all the rest of the money is extra. It's gravy. It's not as high stakes. So that if the market's crashing or doing well, it's not going to change your lifestyle necessarily. So, in the case of someone that is actually using that portfolio to generate income, they could do the reverse of what you were describing about dollar cost averaging. We call it dollar cost ravaging, which we have a whole show on. Retirees can rebalance by adjusting their withdrawal source. So what do I mean by that? If you have income coming from your portfolio, which a lot of people do, say they have a dividend portfolio stock and they have some CDs, right? And so it's giving them income, but they need to be pulling constantly from this. If they see that a particular portion of their portfolio is coming out of balance, like the stocks are really taking off, instead of pulling money from their fixed asset, say the CD, maybe they let that ride and sit and compound, and they pull from the stock market because it's doing well. And by doing that, they're fundamentally rebalancing because they're pulling down from the stock market and keeping it from outsizing. And then the reverse, the stock market tanks. And instead of continuing to pull from that stock market that's going down, they go to their safety side and pull extra from there while they wait for the stock market to rebound. So they could do some rebalancing that way by changing their withdrawal source from their portfolio. So that's a different way of rebalancing than the hard and fast idea of, well, we got to rebalance today. Let's sell this and buy this and get it right back. You can kind of do this gradually as you're living. For most of my clients in retirement, I've been doing this gradual income source change over time. Stock market's doing good. Let's take some profits and use those. Stock market's doing bad. Let's go elsewhere. And people seem to like this. It's not it's not a hard and fast rule. We can have hard and fast rules. There's different ways of rebalancing with that. But for this part, it's more of how are things going and we change on the fly.
Interesting.
There are some considerations, though. Retirees they have to have their income need. That we just talked about that, right? Sequence of returns risk is also important. And we've done shows on sequence of returns risk. This is big for a lot of people. But the idea in a nutshell is in the beginning of retirement, if you are pulling from your portfolio and it's going down due to bad luck, timing, you retired in 2007 and then, 08, 09, you're like, oh, you can run into sequence of returns risk when you're pulling out and rebalancing. So you want to make sure you have your income need elsewhere so that if like I said, if the market does go down, you're not pulling from there. You can rebalance, let it ride. Rising glide path is something I've done a show on too. We talked about how as retirees get older, they actually might increase their risk, which is counterintuitive. And the reason, and my dad would be an example. We have his income need all set, and he's got his money invested in the market, and the market's doing well. But his income need is going up by less than what the market's providing. If he just lets that go because he doesn't really care, theoretically, the amount at risk is going up because it's growing.
True.
And as a percentage of his overall savings, as he's getting older, the amount he has at risk is going up, and it's okay. It's okay to have more risk as you get older if your income need is covered. So that's called a rising glide path, which is, most people think as you get older, your risk should go down. What if your need is taken care of, right? Which then leads to legacy, right? So if you want to leave a legacy to your next generation, then maybe you don't worry about rebalancing and reducing risk because you're not needing it, but
that money's not for you. It's for later down the road. And that means there's time, and time plus market equals compounding interest. Money.
Is, right? Yeah. So you have to have identified what the purpose of the money is.
Right.
Alice in Wonderland says, or the Cheshire Cat says, she asked the cat, which way do you want to go? And which way should I go? And he's like, well, where are you trying to get to? And she's like, well, I don't know. I don't know. He's like, well, it doesn't matter which way you go. So like, if you don't know what the money's purpose is, then how can I answer how to invest it? Should I rebalance? I don't know. Do you need the money? No. Who does? No, I don't know. Do I want to leave it to the kids? I don't know. Do you want to spend it? I don't know. Then I can't answer how to invest.
Right. Yeah. You have to have a goal. You have to assign a task to your money, to each dollar, right?
Yes.
As a financial advisor, I know that you're big on that.
Right. But then again, you could say, well, I want to rebalance because I'm comfortable with a level of risk. So someone might let's go back to my dad. Now let's say my dad is super conservative. He hates the stock market. Well, he's like, I don't want to be in the stock market at all. Well, Dad, you can afford it because you don't need it. And that's the best place to be for long-term growth. He's like, I don't care. I don't want to ever hear the stock market's down and I lost money. So, all right, let's put it in a CD. Fine. Do I need to rebalance? No. Right. Like he doesn't. So if risk is important and your risk is like psychological, that's important, then you rebalance and that's okay.
Yeah.
And then the last one is taxes. So retirees have there's two specific taxes that I want to bring out that could impact rebalancing. Social Security taxes and IRMA.
Aunt Irma, my Aunt Irma. Aunt Irma and Uncle Sam, they always come into the picture, don't they? Holy cow. They are the worst. When they show up at Christmas, Aunt Irma and Uncle Sam, it's like hide your checkbooks and wallets, I'll tell you that.
No offense, Medicare. No one likes Irma. No one likes
no one likes Aunt Irma.
Monthly adjustment amount.
She brings the Jello to the holiday. She brings the Jello mold with cat food in it. Floating.
Or a wrapped cat in a box. So this is a surcharge on your Medicare. So you pay extra Medicare if your income's above a certain threshold. So why I'm bringing this, and Social Security income is not necessarily taxed if your income is below a certain amount. So what I'm saying is if you're going to do rebalancing, it might be a taxable situation as a result of it. So you want to make sure that it's not now going to bump you into where you're paying more for Medicare if you didn't rebalance. So there's a couple of, and just that's an advanced consideration for it. So do we balance, Tony? Balance. I think it's an important part of investment planning. It's not unique to everyone. Everyone needs to think about rebalancing, but when you retire, there's a whole new vision and set of consequences and impacts of things that impact the rebalancing. And so you have to come up with new tactics that you necessarily wouldn't have used when you were younger and still working. So as you retire, you need to adjust your rebalancing strategy. But in the words of Miyagi, if you're out of balance, then that really doesn't matter,
Yeah. It's not going to work. You're going to end up on your keister. That's what he was saying. If you don't have the right balance, right? So
That's it.
the bottom line, though, is to really achieve this, there are so many moving parts. You need to work with a financial advisor and professional who knows about all the options. And I'm not going to name names. Dan Wendell, I know a guy, right? And Dan, before we go, I know you don't like to do this. This is more helpful tips and strategies, but let our listeners out there know how they could get a hold of you if they have more questions.
Yeah, sure. Rebalancing is basic table stakes for financial planning or investment management. So if you have, you just sparked a point that I wanted to bring up, is that another reason people might rebalance is because they have maybe too much concentration of one particular stock. That's another reason people. So if you have a portfolio and all of a sudden Microsoft's doing really, really well, and now that's representing a bigger portion of your portfolio, that might be a time to rebalance. Again, though, that's a risk thing. So you would tone it down because you don't want, the Microsoft to get hit.
Right. You don't want all your eggs in one basket. Some
Right.
people, when they work for a big company or they've gotten stock options, or they're, I've known people who work for 3M, where I live in Minnesota, and it's the big company here. They make Scotch tape, Post-its. They have all their stocks, all their money for retirement is in 3M stock. Well, that's not smart. I mean, 3M is a great company, but obviously, no, you don't want to do that.
Who knows, right? There could be some scandal with the CEO or the ownership or whatever.
Yep.
So so there's another reason. I wanted to point that out. But anyway, if you want to look at rebalancing in retirement and you have some questions about it, you can call me at 888-508-5935. I'll put the number on the screen. And you can also just go to dolphinfinancialgroup.com, and there's contact buttons. You fill it out and say, hey, I got a question about this, or I just want to talk to Dan or Tony. You just go ahead and put it down there and we'll connect. Thanks for a great show, Tony.
Awesome.
And I hope you have a wonderful week, and we'll catch everyone next time.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Wendell nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.